If you're a Canadian investor with a non-registered taxable account, you know the pain of the tax season. Every time your S&P 500 fund pays a dividend, the government takes a bite. And if it's a US dividend, you're often dealing with withholding taxes too. Enter HXS, the total return version of the S&P 500. It is designed to track the 500 largest companies in America, but with a weird legal twist. It's not actually supposed to pay you a single penny in dividends. While most people flock to Vanguard's VFV, savvy investors are looking at HXS as a way to potentially dodge dividend taxes entirely. But is this synthetic structure too good to be true? Or is it the smartest way for a Canadian to own the US market? Today we're looking at what's actually under the hood, comparing HXS to VFV, and explaining the swap structure that makes this fund so unique and interesting. So without further ado, let's get right into it. So what is HXS? Officially, it's the Global X S&P 500 Index Corporate Class ETF. In plain English, it tracks the total return of the S&P 500. That's it. But unlike a regular fund that buys the stock directly, HXS uses something called a total return swap. Basically, the fund enters a contract with a big bank where the bank promises to deliver the exact performance of the S&P 500, including capital gains and dividends, directly into the stock price. And because of this setup, the dividends are essentially baked into the price of the ETF rather than being paid out to you as cash. If you buy a share, you're looking for the share price to grow. This makes it an incredibly popular tool for a high-income earner who wants to own the US market without adding more taxable income to their yearly tax return. The biggest showdown for Canadian investors is HXS versus VFV. If you're investing inside a TFSA or RSP, VFV is usually the winner because tax efficiency doesn't matter in those accounts. And VFV has a slightly simpler structure. But in the taxable account, HXS starts to shine. With a regular fund like VFV, you pay tax and dividends every single year. With HXS, you generally only pay tax when you sell the fund. And even then, it's taxed at a much lower capital gains rate. As for the cost, HXS MER is around 0.1%, but there's a catch. Because it uses swap structure, there is an additional swap fee that can actually add up to 0.3%. While this makes the total cost slightly higher than VFV on paper, many investors find that the tax savings on a non-registered account far outweigh the extra fee. It's a classic case of paying a little more in management to save a lot more in taxes. So, something to think about. Since HXS doesn't actually own the stocks of Apple, Microsoft, or Amazon directly, we have to talk about the risks. This is what's called a synthetic ETF. So, your return depends on a contract with a counterparty, usually a major Canadian bank like National Bank. If that bank were to theoretically default, there is a risk to the fund. While these contracts are heavily regulated and collateralized, it's still a different level of risk than just owning the physical shares. There's also the legislative risk. The Canadian government has looked at these swap-based structures before and made changes to how they are taxed. While the current corporate class structure is designed to keep the fund tax efficient, there is unfortunately, always a possibility that tax laws could change in the future. For most people, the extra efficiency is worth the trade-off, but it's something you definitely need to be aware of before you move your life savings into it. When you look at the HXS Holdings, you won't see a list of 500 stocks. Instead, you'll see cash and the swap contracts. However, the performance you get is exactly the same as if you own the index. You're getting full exposure to the massive tech growth of companies like Nvidia, Apple, and Google, as well as stability of the older US industries. One major benefit of this structure is that it almost perfectly tracks the index with very little tracking error. Regular ETFs have to constantly buy and sell stocks, pay commissions, and deal with currency conversions when dividends come in. Because HXS just receives the total return from the bank, it avoids many of those hidden costs. You get a clean, efficient version of the most famous stock index in the world. A lot of people check the HXS dividend history and get confused when they see a big fat zero. And don't worry about it, you aren't losing the money. In a regular ETF, when a company like Coca-Cola pays a dividend, the fund collects it and sends it to you. In HXS, the dividend value is added directly to the net asset value, NAV, of the fund. Essentially, the fund is reinvesting the dividend for you automatically before the taxman can get to them. And this creates a next level kind of compounding machine where you only trigger a tax event on your own terms whenever you decide to sell your shares. For a long-term builder, this is like having legal tax-deferred account hidden inside your regular taxable brokerage account. It's a very interesting setup, and there are a lot of people who can benefit from it. So is this the right S&P 500 fund for you? It really comes down to which bucket you're using to invest. So I would say choose HXS if you're investing in a taxable non-registered account, you have high income, and you want to minimize your yearly tax bill while maximizing long-term capital gains. Then I would say choose VFE if you're investing in a TFSA or RSP. In those accounts, the tax magic of HXS doesn't really help you, so you're better off with a simpler, lower fee physical fund. And lastly, I would say you should stay away from it if you're uncomfortable with the idea of swap contracts, or you don't really trust them a whole lot. You prefer the peace of mind that comes with owning the actual physical shares of underlying companies. Anyways, guys, thank you for watching. This is just a quick heads up. As always, this video is for educational purposes only. I'm not a financial advisor, just a guy sharing my research and opinions. So definitely do your own homework before you move any of your money around. If you found this breakdown of the swap structure helpful, hit the like and subscribe button. It helps the algorithm realize that these deep dives are actually useful for the community. And it means the world to me. Thank you once again for watching the video, and I'll see you in the next one. Take care.